Why are interest rates crashing? We're talking 25% below where it was just 3 months ago. Why? What's causing that? You don't have interest rates crashing if inflation is imminent, right? Because what happens to kill inflation, what we thought we understood in the Paul Volcker, Ronald Reagan era of 1988, 1982, is you raise interest rates. So let's read this from Seeking Alpha. Such a good article here by, actually, I'm not sure who wrote this. It's such a good article, man. A prolonged drop in U.S. Treasury yields is catching bond and fixed income traders by surprise, as well as other investors in the broader bear markets. The 10-year Treasury dropped below 1.3%. It was at 1.29 last I checked. And last night fell to 1.25, despite lingering concerns about rising inflation and a gradual removal of Fed stimulus. This is happening. Treasury yields play an important role in the economy. All right? But what's happening? While the move has mystified many traders, so I tell you, everyone seems to have this is what's causing it, and yet no one knows. This is what drives me crazy about commentators. Well, the Fed's buying up the bonds. How come Schwab isn't saying that? How come these guys aren't saying that? No one knows, man. It's crazy. What is causing the yields to drop? It's crazy. We'll keep reading. Some are ascribing the reverse to changing narratives and new developments. The market is sort of taking a deep breath, says a guy at Société Générale. And I've been following Société Générale for many years. They do some good research. They had a lot of issues 10 years or so with some serious shenanigans. Are those optimistic forecasts for economic growth and inflation actually achievable? All that seems to be implying this is Schwab's chief fixed income strategist. This is implying that perhaps not only was the inflation transitory, but maybe some of the growth has been transitory as well. Again, this is Schwab. This isn't just some podunk guy with every socialist is a disguised dictator shirt in his underwear with his two dogs. This is Schwab's head of freaking fixed income. So what is causing it? They don't know. The muscle memory of markets is that governments will lock down again because of Delta variant. Here's a guy from Mediolanum International Funds. All right, whatever. So this guy's trying to say because of Delta variant. Yeah, okay. Delta variant. It's just the whole thing's freaking insane. Tuesday's ISM reading just added more motivation to extend the move into Treasury yields. Basically, to extend the move into Treasury starts making the yields lower. So remember, all the time, it's just simple. If their price is going up, that means the yields are going down. So when you see a yield dropping in bonds, that means the price is going up. A reduction in the Treasury general account, which the U.S. government uses to run most of its day-to-day business, is being wound down, shrinking the supply of bonds. Shrinking the supply of bonds? Well, that's weird, because I thought the government was wanting to step back and allow for interest rates to go up. So if you shrink the supply, a big portion of what we're seeing is a capitulation of the higher rate thesis, says J.P. Morgan. Some short covering has occurred, but the breadth of bearish duration positions remains on par with 2017-18. Most analysts had expected 10-year to hit around 2%, but I thought that that's what a shrinking of the supply of government bonds. They're winding down the government's theoretically exposure to buying up bonds. So a shrinking of the supply does what to price? Less supply, same demand, higher prices. Higher prices, lower yields. But so even we all knew this. This was telegraphed. But most analysts had expected 10-year treasuries to hit 2%, given that we know the government was going to ratchet it back already, and yet it hasn't come anywhere near that. In the first quarter alone, the yield soared from 0.9, 90 basis points, to 1.75 as the reflation trade took hold of the markets. But it looks like the move lower is now staying firmly in the opposite direction. Longer-term yields are also a closely watched economic barometer, with the rates tending to fall on weakened economic growth. Isn't that interesting? So let's take a look at some of the comments, because a lot of times some of these guys comment real good. Some real smart gravy you can get from some of these comments, that's for sure. So let's see what these guys say. Wow, now we got 166. We're not going to read them all, but the analyst forecast says extend trend line using a ruler, put out the forecast. Yeah, with the trends change, they grab the ruler again. Yep, looks like Joe Average isn't buying Wall Street traders BS. Bravo Sierra. Yeah, right here. I'm reading this and I don't I still don't know what I read. I just know that several folks made some noise about what they think it means. It just shows that they don't know what it means. The plunge protection team will be taking action soon. Expect some announcement of a new stimulus. Yeah, I would not be shocked there. Let's keep reading here. Let's see. With free work from home and the Titanic debt overhang, of course, the growth is temporary. Oh, free work from home money. Yeah, that's all these high inflation narratives are created by the money makers. Don't believe them. Stick to high quality growth stocks. Well, whatever. That's just what this guy's saying. Again, no one knows nothing, man. It's crazy. Crazy. The idea that, oh, because the repo market or the housing or no one knows anything. It just protect your assets, man. Just you got to pay. You got to just watch the bottom line, because if people are slowly starting to realize, as I've been saying, inflation is transitory and growth is transitory, that doesn't mean we're not going to get growth. Japan's got a little bit of growth. It just means it's not going to be much, which means fixed income will be a more valuable asset. All right, we'll see you.